You've been searching for the best way to generate passive income in your life and heard that real estate is a great way to do it. But you're tired of all the so-called gurus who are all talk and no substance. Get ready to celebrate because Kevin Bupp has spent 14 years successfully making it happen. This is the Real Estate Investing for Cashflow Podcast. Now, here's Kevin Bupp.
Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cashflow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. And our guest for this week's show is family office expert and serial real estate entrepreneur, DJ Van Keuren. DJ is the vice president for the Hayman Family Office, the single family office of the Hayman family, who was the founder of Giorgio Perfume. There he is responsible for family office capital and the real estate activities which support Hayman Properties, an affiliate of the Hayman Family Office. Over his 25 years of experience in real estate, finance, investment banking, and fund management, he was the managing director of the American Dream Fund and has been responsible for the underwriting of over $2 billion of real estate assets. Additionally, DJ is a member of the Forbes Real Estate Council, author of Real Estate Investing for Family Offices, founder of the Family Office Real Estate Institute, the Family Office Real Estate Podcast, and the Family Office Real Estate Magazine. DJ received his BA from Ball State University, attended graduate studies in real estate from the NYU Schack Real Estate Institute, and received his master's degree from Harvard University in Management and Finance. So guys, in today's show, we're going to be covering a variety of topics with DJ, including, for those that don't know, what is a family office? How we real estate investors can tap into the worldwide family office network as a potential source of funding for our deals, and also strategic partnerships and relationships to ultimately help us grow our investment business. What types of investments are family offices seeking today? How we can appropriately approach a family office with an investment opportunity, talk about normal deal structures when partnering with a family office, and much, much more. And so with that, guys, I'm excited to get on to our call with DJ. So DJ, how you doing today, my friend?
I'm doing good. Thanks for having me.
Yeah, thanks for joining us. I know you're a busy man, so I really appreciate you taking time out of your day to jump on the call here. And so first and foremost, I'd like maybe to pass the ball back in your court, DJ. And I did give you an introduction there, a little bit of your background. But if you could maybe fill in some of the blanks for us and tell us a little bit more about yourself.
If I go all the way back, I had started back in the 90s as an advisor. I sold that practice, went to Asia for a number of years. And when I decided I was going to come back, I said, what do I want to do? Right. And it inevitably came back to, well, I love real estate and I'm passionate about real estate. So when I came back, I raised some private money and I started the American Dream Fund, which was actually going to be the first single family REIT. I was about 10 years ahead of everybody else, unfortunately. Yeah. And so I can tell you, not only how much things have progressed in that phase, but also what I see as potential, challenges for Blackstone and some of the Colony and some of the big players. But after that, I sold it because one of the things that I did is I picked up and read everything I could on real estate, which from, if you remember Carlton Sheets, I read his stuff all the way up to classes at Harvard and everything in between. And what's interesting is that all goes full circle. So even the things that Carlton's talking about are totally legitimate. It's a lot of the main fundamentals. But one of the main books that I read was Timing the Real Estate Market Cycle. And that really allowed me to understand, the ebbs and flows. And because of that, I was able to sell my portfolio before the downturn. Mm-hmm. Then I went back to grad school at Harvard. And after that, worked for a number of developers throughout, did some investment banking on the real estate side, and then sort of fell into the family office space. And how that happened was I had worked for a family, one of the largest developers out of Mumbai, and we were buying luxuries, hotels and condos out of Manhattan. So everything that we were structuring and doing, was between 75 to 400 million. So very, very big size deals. And then when I moved to Colorado, about a year and a half, I said, I don't really know anybody. And I started meeting people and ended up falling into a family office. And the gentleman he created his wealth out of real estate. And the reason why they asked to see my resume was because when he dies, all his money was going to go to his foundation. And so they wanted to start bringing some outside capital. And they asked me, what do you think? Well, all of my relationships were with the institutions, the Carlyles of the world, the Apollos. And I said, well, family offices. And at the time, I only knew two. And what was great about why I ended up, coming aboard and saying, okay, I'm going to help you do this, is because he had sold a yogurt company about 30 years ago for $1 million, and he turned that into $600 million.
Wow.
And he did that in real estate. And his philosophy was what I had totally believed on. One was market cycles, because we do go in different cycles, and actually, you can go back 250 years and you can take a look at the cycle, not only here, the US, or here, Australia and the UK, so you can tell where we are in the cycles. But also, he was buying deals between 10 to 25 million, which is underneath the big players, the institutions. And also he did value add. So all he bought was value add, did some development. And he actually sold 80% of his portfolio before the downturn as well. So, here's somebody that I was like, well, I want to learn. But so I fell into the family office space, and then I was headhunted by the Hayman family that you'd brought up. And like 95% of us that work for a very wealthy family, we just sort of fell into it. And that's, really how I got into this quote unquote club. And, that's where I plan on staying the rest of my life.
Okay, fantastic. And just to get a better understanding of the definition of your role within that family office, I mean, if you gave yourself a title, would you say the director of investment and finance for the Hayman family? I mean, is that ultimately what it is you do?
Yeah, before we were doing other investments outside of real estate with my old family office, we were putting $100 million into oil and gas. And then we had 5 solar parks. We had 3 people actively trading equities, et cetera. In this family, we're a lot more boring in many regards. And about, I'd say 6 to 8 months ago, I said, you know what, I just am going to focus strictly on the real estate portfolio and what we're doing with the real estate. And so that's where my total focus is right now. So, my title is vice president of family office, and but my focus is strictly in the real estate area. Okay. And that means not only helping with the overall portfolio, but also strategy. If we're bringing in outside capital, then I'll look to go to my relationships with the families that I know.
Mm-hmm. Fantastic. What are some of these sectors that are getting you guys excited today? I mean, where's most of your focus at?
Well, that's interesting. I can do this from two sides. I can tell you what we're doing, and then I can also tell you the family office in general. From our perspective, we haven't bought anything in about a year and a half. Okay. And the reason why is because we've been focused on office, because we've got this brand concept, which is a boutique office brand, which is similar to like a boutique hotel. But we have been active in the sense we just sold off our last position in a multifamily. And, we've been doing a lot of refinancing. So our strategy internally is that we want to build up as much money as we can, because, I see a downturn coming in the next 12 to 18 months, and we sort of want to be ready for that, to take advantage of that. Now, that doesn't mean that we're not going to find opportunities along the way. It's just, as it's gotten harder, over the years to find better and better deals, because a lot of them have been taking, or more people have entered the market. But, we're pretty strict on what we look for. So we'll continue to look, try to find good opportunities, but be very specific on whether we're going to pull the trigger or not.
That's interesting. You'd made a mention that you guys set off your last interest in multifamily, whereas it seems as though the market in general is still incredibly bullish on multifamily, even though cap rates have been compressed across the board to all-time lows. And so just generally speaking, I mean, what's your take on that? I know that you say you see an imminent downturn occurring in the next 12 to 18 months. All real estate's local. We can all agree on that. So that's not just you can't take a broad brush stroke across the entire nation and say there's going to be a downturn. But just from your standpoint in multifamily, why did you guys have the feeling that, hey, we could kind of back out of this and hold on for a little while before we see what happens?
Yeah. So, and you definitely bring up the aspect that real estate's local, right? But if you look at it as a whole, first off, because that's where you've got to go to. Multifamily with Class A is definitely overbuilt. That's where everybody ran to initially. Cap rates are compressing, like you said. You've also got a lot of inventory that's coming to market. I mean, here in Denver, we have 2 years of excess inventory that's coming to market. And what's going to happen there is that your vacancy rates are going to go down, right? And then they're going to start slipping in and affecting the Class B properties, the lower properties that are charging less, right? Now, long term, Denver wise, I think we've got a good 10-year run. I mean, we got a lot of growth. So long term, there's a great opportunity. But, you combine all the excess inventory, you take a look at construction costs, and I'll tell you a story about that. But construction costs are going up. Interest rates are climbing as well. And so we just see that there's, too much that have been running to that area as a whole. And so that's why we decided to say, we're going to sell, we're going to take our profits, and we're going to hold tight. So, there's usually a 9-month lag with multifamily too, until you really start seeing, the effects of what's been taking place. But we see that there's going to be an opportunity coming in 2021, 2022. And ironically, that's the same as my old patriarch who, made his money based upon these cycles and value add and stuff like that. So, there's just so many factors that are happening. I think that, there's definitely some opportunity on the workforce housing side, and there will be long term. And I personally, on the apartment side, I think where you shoot the gap is in senior apartments. I think that senior apartments is an area that there's definitely opportunity, even today, and they're not as affected as other parts of the economy, and not everybody has been focusing on those senior apartments, although that's starting to increase.
When you say senior apartments, you mean like the independent living?
No.
Not assisted, but independent where they don't really need the assistance today, but it could be there, or are we talking about something completely different?
No, we're talking about the independent, the 55 and older.
Yeah,
55 and older, because that's one area that you can, quote unquote, discriminate, say, right? But you've got these people like my parents that, they've lived in their house for 35, 40 years, and they're like, hey, I want to, we're going to sell everything. We're going to sell the house, and think of all the things that have accumulated in that house for the last 30, 40 years. Well, if they go ahead and they move it out and move it into storage, they're not going to want to do that again. And so here you've got sticky people that are going into those units where they're probably going to stay until they go to the next phase of their life, which would be more the assisted living type thing. And their monies that they're paying their rent is not affected by the economy, depending on what caliber of properties that you have for senior apartments. That's what I would call sticky money. It's continuing to, they're just going to continue to pay because they're in their retirement phase and they've already done their saving, and that's just part of their expenses.
Sure. No, absolutely. It's one of the big reasons we love the manufactured housing space. A little bit different in terms of sticky, but ultimately it costs a good bit of money to move one of the manufactured houses out of the community somewhere else. And so there's very, very little turnover. And we've got residents that have lived in our communities for 20 plus years. Yeah, it's just the cycle continues on, and you really don't have that turnover like you would in a normal conventional apartment complex.
No.
So, well, let's get back to the discussion of family office. But that was great. I appreciate you giving me some feedback and some additional dialogue there. And I do want to ask you about your crystal ball as far as the market timing. But let's save that for a little bit later in the show.
Sure.
Because obviously you've done a lot of studies in that, and I know which book you're referring to as far as timing the market cycles. And it's one that's not commonly discussed. I don't hear many people at all, and I forget who the author is, but I've got it on my shelf and I can't recall his name. I've tried to get him on the show, but he's tough. He's tough to get a hold of. But in any event, let's talk about family offices and our listener base here. They're active commercial real estate investors. Again, they span the gamut as far as asset types that they invest in, everything from self-storage to multifamily to office to retail and everything else in between. And so let's talk about that typical relationship that might exist between a real estate investor and a family office, and ultimately how that usually plays out.
Sure. So, the definition of a family office, let's start there because that's sort of loosely used. But you've got a family office is really where somebody's created a significant amount of wealth, or they've had an exit, right? And then they're like, well, I've got to invest this money, not only for myself, but for future generations, right? Because I want my kids' kids to be taken care of and everything else. And so, there's people like Bill Gates, Michael Dell. Michael Dell's still working, but he's got his own family office where they'll invest that monies. And typically, I would say that the real number where people have family offices is if their net worth is worth $250 million or more. But yet you still have people that are, $100 million that if they're planning everything for their family, technically they could be considered a family office, but it's usually the larger families. And it is a relationship business, just like you kept bringing up that word relationships. In fact, that's how, when I said 95% of the people get into the business by just happenstance, that's because somebody sells their company, they're sitting on 400 million, and they're like, now what do I do? Well, I trust my banker, I trust my accountant, I trust my guy that was handling my financial planning. So I'm going to bring him aboard and let him figure this thing out. And so you do get a lot of people like that are in the industry. But the biggest thing I think that people need to realize is that, one, they're just like you and I. And in fact, absolutely amazing. There's no egos. I haven't ran into any egos whatsoever. And they're just really good people. But they've also spent the last 30, 40 years, in the chemical business or making widgets, right? And so they really don't understand not only private equity and hedge funds, but they don't necessarily understand the intricacies of real estate. Mm-hmm. So what's good about that for people like your listeners is that, if you build that relationship, then you can be there to say, hey, okay, I know real estate. Let's partner up here. And in fact, someone just called me that I got off the phone about an hour ago that had told me just that. There's a gentleman that sold his business for $200 million downtown Denver, and he had partnered up with this guy who was a local operator to help fund a project because, they either don't have the expertise, they don't have the time, they don't have the infrastructure in order to monetize it, or monitor it, etc. And so family offices, although it takes longer to build that relationship, and they might start out small, they might only give you $250,000 or $500,000 or $2 million, but there's a lot behind that once they get the trust from you. And so it's one of those things that are worth it to build that relationship because not only can they be a source for you, but you can also be helping them as well.
Where does that relationship start, though? I mean, is it typically, are you the point person for the family and others like yourself in that particular role? Or would you become the point person?
From my perspective, I do. And a lot of people in my position are sort of like the gatekeeper, I guess you could say. Mm-hmm. But we've got influence or decision-making ability or whatever the case is. And so you definitely want to make that relationship with the person that's sort of in charge. And a lot of times they're called the CIO, Chief Investment Officer. The other thing you do have to make sure is that just because you meet a family member of a very wealthy family, it doesn't mean that they have any decision-making authority. So you also want to be careful about how much time you spend. But, a lot of times it just comes around from, who do you know? And, before you know it, you're sitting in front of somebody that's worth a lot more than you ever expected mm-hmm. to be. And, you just get to know them. The one thing I will say is that anybody that has significant wealth and is worth hundreds of millions, if they created their wealth in real estate, 99% of the time, that is not going to be your capital partner. It's going to be the family that didn't make their money in real estate. And that's something I think is very important to know because a lot of people think, oh, they're real estate people, I'm going to talk to them. Well, it doesn't work like that, unfortunately.
No, that's a valid point. That's one I've never thought of, but it makes a ton of sense, right? I mean, they're experts in that space. Why do they need you?
well, and it's what's interesting too is that you go to Mark Zuckerberg and you're like, hey, I'm doing this technology deal. There's a very high probability that he would invest because he would say, oh, I get it, I understand it, right? Because of Facebook or whatever the case is, and so I like that idea. But in real estate, you could go to somebody, they're like, I like it, I see it, but I can just do it myself. So why do I need you?
Mm-hmm.
And so that's something that, not everybody realizes.
Mm-hmm. What is the typical, maybe there is no typical, as far as investment horizon? Like the investments you guys are making today for the Hayman Family Office, do you guys have that long-term picture? Or are you guys, get in, get out every 3-5 years, exit at the top of the cycle?
Yeah, that's a good question. So a lot of our investments are primarily to that 3 to 5 year marker. Now we've got legacy assets. Like one of the legacy assets we have is we own the Louis Vuitton building on Rodeo Drive. And that's been in the family for 40, 50 years, right? And so that's just held long term. My patriarch also bought a building, for his kids that he's just going to hold forever. So it depends on what that philosophy is, but you either get families that want to go short term, 3 to 5 years, or you get the other side of the spectrum where they want just to buy and hold. And when that happens, the big thing for them is part of the name of your show, which is cash flow. Mm-hmm. They want cash flow, right? So if you've got a good performing asset and it's a multifamily or whatever the case is, and you said, hey, let's just hold this thing for a long time, there's a tremendous number of families that would say, that sounds perfect. That'd be great.
Got it. Now, it looks like you're obviously the creator of a magazine that's directed towards the family office space, a podcast. Yep. You've created a fairly large network. Is it that network where we actually get to rub elbows with guys like yourself that are basically the director of these different offices, family offices? Or, what's your recommendation as far as us getting out there and actually networking and meeting folks that might have an interest in our investments?
Yeah. So, there are, I think the last time I saw, there was 5 companies that have lists of family offices, but they're very hit or miss. You might only get 25% that are really family offices or contacts. So I don't know how much time or effort I would really spend on those lists. But the best thing that you can do is to go to various conferences. And if you Google family office, conference, or family office, real estate, conference, you're going to get a whole slew of them. And those are the places where you're going to run into families. Carmo Companies is one that focuses on real estate, and they have a big focus on, family offices and the Latin market or Mexico, etc. You've got Opal Financial Group, which they'll do family office events, and they'll do conferences specifically for family offices and real estate. So there's also an organization called IMN, which is at imn.org, and same thing. They've got family office, real estate conferences. And then depending on where you live, I would Google it, and don't be surprised if you find that. And that's really, that's how I started building my network. And, the first year I knew 2 people, I think I told you. And by the end of the year, I knew about 200 families. But that was because I went to an awful lot of conferences. Mm-hmm. I just kept going and meeting people. And literally when I was at the conference, I'm like, okay, I'm here to meet people. And so I'd meet like 15 families at a time. And you just got to keep working at it and then build that relationship.
Yeah, what I kind of consolidate that into is get out there and network. I mean, just generally speaking, get out there and talk to people, right? I mean, that doesn't necessarily mean just going to, just seeking out the family office conferences, but, it could be your country club, your golf club, other different social networks where there could be affluent people hanging out, right? I mean, for all we know, the guy that drives the beat up pickup truck is that guy that is worth, $500 million, which is quite commonly probably the case.
Yeah, it's totally the case, and you just have to ask, who do you know? And it does come down to not only the fundamentals of asking and networking, like you say, but also the fundamentals of any investors you do have. Take care of them. Mm-hmm. Communicate with them. Just keep in touch with them. Obviously boast about the positives and the things that you've done, because they're going to talk to other people. And that's part of that whole networking part.
Got it. I want to back up a little bit. We talked about the crystal ball a little bit, and you're a really big fan on market timing. Talk to me about that a little bit. I mean, what's the risk that you see other than just rising interest rates? I mean, what are some of the other risks that you see that are compounding that ultimately could create a correction here in the next 12 to 18 months?
Well, I'm going to go back and answer that a little bit differently to not only to what I see, but one of the things that we can do is we can learn from history. And there's a book which it's escaping me right now, but it goes back and it shows how there's actually historical information that shows the cycle in Australia, the US, and the UK. And the UK and the US is pretty running on the same path per se, but it runs in 18-year cycles. And so what happens is that you go into a recession. After recession, things start moving out. You've got good buying opportunities. Things start, taking off. And then inevitably, you've got a slowdown, which could be anywhere from 6 months to a year. And then after that, the next phase continues to go up for another 5 years or so at a faster pace than the initial pace, right? Before the initial upswing. And then you hit the recession. And, that is from the same things that we do as human beings over and over again, right? We hit a recession, everybody's worried. Then finally they start coming in, lenders start freeing up a little bit more, things start doing better, people start making money, then they start building too much, interest rates go up, right? And then you got too much supply that can handle, what's available that can take up that supply, and then banks feel happy and they continue to go and they lend more. And it's just this cycle that continues to happen over and over again. So that's the first thing is that, you take a look at that, and based upon where we are, we should see in the next 12 to 18 months a downturn. Then we'll see another upturn to about 2027, 2028. And then we'll hit a recession. But between, 2021 and that 2026 or so, that's going to be even better than the last upswing that we've seen since 2008. So, but right now, what are the signs? Well, the interest rates that have been going up overbuilding, which is what I was talking about, like on the multifamily side. You get people start hopping in to the market that may necessarily haven't done real estate before, but they see people making a lot of money. They want to jump in. The rising construction cost is another one as well, because that keeps going up. But like you mentioned, it depends on, the property type as well as where we are within the U.S. And there's a couple of reports that are very, very good that track that. Actually, right now, industrial is a good buy. Hotels is a good buy. Office, is behind the curve. And so that's where we're at in the cycle right now, where you're having all those different nuances.
What do you see as the future of office? I know you made a mention that you guys are focused on a boutique type of product. And I know a lot of, office typically gets clobbered and takes longer to recover in any type of recessionary period or recovery period. And so give me your take on office and what excites you about this boutique business model that you guys are focusing on.
Well, the big thing that's been happening in office, which is the WeWork, right? The WeWork phenomenon, because that Regus was always around, but WeWork's really taken it to a whole nother a level, what's really taken off. And the one thing I will say, and so then you have a lot of other players that are jumping into that game. Well, WeWork's is not profitable. Actually, today I saw something that said, I think Sophie Bank was going to make a big investment, and they've cut back significantly because what's going to happen in the downturn, people don't know. And you're starting to have some big landlords that aren't allowing WeWorks to be in their building. And WeWork never, until they're just starting now, but they never bought any of their buildings, right? So, which to me, that's where all the money is, just like a McDonald's. It's not in the operating business, it's in the real estate itself. And so, I think that definitely is playing a part on office. There's about 10 million office buildings in the U.S., of which close to 6 million are Class B. And that's a huge opportunity on the value add side. And how we came up with this brand concept was, I was looking at the portfolio, And my principal kept saying boutique, boutique when he talked about these buildings. And then all of a sudden it hit me. I was like, oh my gosh, we had the ability to build what would be the first boutique office brand in the US. And, it's the difference between going to a Holiday Inn or the W. If each one was $100, where would you go?
Yeah.
Well, you'd go to the double, right?
Yeah.
And so that's basically the concept, right? Playing with themes and imagery and that feeling, so that people want to be there, because you spend so much time at the office, you might as well enjoy it.
Mm-hmm.
And so that's exciting, but also from my experience, I also know that where you can really make more money is if you roll up your assets and sell it as in bulk. So initially we were going to go out and do 10 or 15 of these, roll them up, sell them off to a REIT or an institution. And now, he's talking about wanting to do hundreds of these things. So, it's something that it's something that's more sticky, I think, than your regular office building. And you can also play on, oh, I'm moving into this other area. There's a building that I used to have my office in, right?
Mm-hmm.
And so I understand it. It's no different than when you go to a hotel and you're like, I know Marriott, I know Westin, I know what I'm getting when I go there.
Sure. What do you guys foresee the timeline as far as if you do go into this larger scale strategy of hundreds of these boutique hotel concepts? How do you ramp something like that up, and then what kind of time frame you're looking at as far as this roll up strategy?
Well, we're sitting on about 9 right now, and we've been really focused over the last 9 months on systems and processes, because I'm sure you've talked about that before. To build any type of portfolio, you've got to have systems and processes and controls, right? So that's what we've been doing with that. And you can't run until you have that in place. So that's the first thing that we've been doing. And, I think it's going to be a lot more organic and slow growing than I think he realizes that we're going to do. Because even at my old family office, we had about $3 billion on the books, but we were doing probably 30 deals a year. We bought about 30 properties, and that was moving really quick. And we had 90 people supporting that. So it's a lot harder, So I think that as we start ramping it up, it's going to be one of those things where we'll buy 3 or 4, and then the next year maybe 5 or 6, the next year 6 or 7, and just step by step is really what's going to happen.
Yeah, I was going to say, even from the acquisition side of things, to scale up to get to the 100 level in any given year. I mean, it's such a massive operation.
No, it's basically impossible, And then you've got to start looking at different markets. So we've been in like Denver, Salt Lake, Austin, Dallas, Houston, and then Seattle. I mean, we're looking into Portland, where I think there's some opportunity. But then if you want to start getting better, higher returns for the strategy, you've got to start taking a look at other markets, like a Charlotte, or you got to start looking at a Boise, Idaho, Orlando, markets that are a little bit behind the curve, but there's going to be a lot of growth happening, on a go-forward basis.
Do you mind sharing the name of the concept or no?
Yeah, sure. No. The name is Vibe. And so VIBE. So we've got properties that are like Vibe Hobby, which is near the Hobby Airport in Houston, Vibe Art District, which is near the Art District in Denver. We've got Vibe Surfside, which is actually in Southern Cal, right on the ocean. Vibe Cottonwood, which is in an area in Salt Lake. So it's under the name Vibe, and we've got, then we attach to it something that's relative to that area.
Okay. Very interesting. And then what kind of premiums are you finding, like in comparable size office space and in the same geographic location? What kind of premiums are you guys getting per square foot in rents based on this higher end concept? Yeah.
Well, a lot of these buildings are already under market, right? Because it's the value add play. Where the big difference is happening initially out of the gate is that we're able to lease it up quicker. Got it.
So someone's going to choose yours versus, like you get the whole, the W versus the Holiday Inn.
Yeah, so, exactly.
Yeah, got it.
Yeah. So I say, downtown, it might be $100 a square foot, where right on the edge or an infill location for a Class B, let's say it's $70. Well, now you're going to choose between that 80s vintage office for $70 or ours for $70.
Got it.
Where are you going to go?
Yeah, makes sense. Well, fantastic. Well, back to the family office topic. I know that we're jumping around here a little bit, but
Sure.
Is there anything that we might have not covered that you feel would be relevant for our listeners regarding family offices and how that pertains to us real estate investors and that potential relationship together?
Yeah, I think that you've got to continue to network, like you said. Understand that it's definitely relationship focused. I would even suggest that you don't even talk about the deal maybe the first time. You don't do it to their second or third time, but you keep in touch with them, etc. They'll ask, well, what are you doing type deal. And when you do ask them, it's even as simple to say, hey, we're working on this project. You want to take a look at it? And they're going to tell you, yes or no. The average allocation to families are right around 15% is how much of their monies that they allocate toward it. They definitely love multifamily. That's the flavor of choice.
Doesn't everybody?
And, I think one of the biggest things, though, is that with the way how the family office name has been getting bigger and bigger, that some people say they're a family office, but they're not a family office. So you just got to sort of, talk to them about to try to figure that out.
Is that more ego? Is that more ego playing into that?
No, it's because people are using that to try to get to know other families.
Oh, okay.
Because like if you called 50 family offices and left messages, one might call you back. If I call 10, 5 call me back. Mm-hmm. And that's because I'm with a real family,
Yep.
And so, and one of the questions I ask, because I'm curious, is, what industry was the wealth created? And that just happened because I was just curious. And it's been fascinating because, where the wealth was created, sometimes you're like, really?
I know. Yeah.
Really? You did how? I can't believe that you made it off of piping,
Yeah, you made the connector for the connector that
right.
Attached the car with. Wow, how did you come up with that niche?
Exactly. And so, by asking that question, though, you're going to find out. They might say, hey, real estate. Well, all of a sudden you should say to yourself, okay, they're not going to be a partner for me.
Got it.
Or they could say, well, I made it in chemicals. Well, cool. I know that, did you sell your business? How long was your business around? Yeah, well, we sold it 2 years ago. Well, that's probably a good indication, right?
Mm-hmm.
That they're sitting on some money, probably.
Yep. Fantastic. Well, DJ, you've shared a lot of great information with us here today. I really appreciate you coming on. And now we enter in what I like to call the golden nugget segment of the show. And what I'd like to ask of is, if you just had one final golden nugget of advice or wisdom that you could leave with our listeners today that may inspire and motivate them as they progress in their real estate investing career, what would that one last golden nugget be?
That is a no-brainer for me. That if you find that perfect deal that you don't want to lose, don't worry about it, because you're going to find something as good, if not better, tomorrow.
Isn't that great? I love it. That really is the truth. And
it's totally the truth, because you want to, right? You're like, oh my God, here's this great deal. And so you want to cling on to it. And sometimes you'll cling on to a deal that's really not a great deal, but you just want it so bad. And so, it's going to be okay, and you're going to find something better, like I said.
Well, I think the beautiful thing behind that is when you can truly embrace the concept of moving on. And taking your energy off something that's just not like you're trying to make a deal out of nothing, or you're putting all this emphasis there, is that the ones that you truly just, not act as though you don't have an interest, but you're not begging for the deal, or the ones that literally chase after you. I mean, like, they're the ones that come, I don't know, for example, like, just, I've got enough deals coming through the pipeline, we'll give the time of day to everything, but ultimately we surely won't beg for something. We won't overpay for it. And we'll move on to the next very quickly. And I find that a lot of those that we move on past come back to find me, even ones that we've made an offer on, someone's willing to pay more. I'm pretty confident in my underwriting. Those things fall apart because, again, the next person that took it, realized that he was overpaying for it, and they end up coming back around after they wasted 60 or 90 days of due diligence, and they come knocking at our door. So just keep the focus, get very firm in your underwriting, be very black and white, and just keep building that pipeline. Never get caught up on one deal.
No, and that's, if I may, I'd like to add one more thing that I think that I learned from my old family office is that he pick a target that you want from a return and model it out. And if you can't get that, stay to it. Because, here we are looking at a $30 million deal. And I'll never forget somebody in the office at the old family office said, geez, we're only $100,000 difference. Well, on 30 million, that's not much. But the patriarch was like, no, I need that in order to make the deal hit my guideline that I've got to get a 25% IRR. And because that was his number, and he wouldn't budge. Inevitably, it pays off in dividends. So, pick that number, take out the emotion, and stick to it.
Yeah, that's interesting. I just literally had a conversation about 2 hours ago with it's only a $9 million portfolio play of two manufactured housing communities, and we're literally $300,000 apart, and it's significant. I mean, that's significant enough on a $9 million deal that it ultimately affects our returns. And I'm not willing to budge. And I have a feeling that he'll come around because we're not too far apart to where it doesn't make sense to move forward with us as a buyer. In any event, we're pretty strict with our criteria, and I'll be prepared to move on. And I have a feeling he'll come back because he knows we're real and he knows we can execute. So,
right, that's great.
DJ, this has been fantastic. How can folks that are listening and how can they get in contact with you, learn more about what you've got going on in the back end? I know you have multiple websites, but please share the best place for us to contact you at.
Sure. Well, the best place to get, to find information about me or what we're doing is simply my name, which is djvankeuren.com. So that's DJ, V as in Victor, ANKEUREN.com. And there is, not only information about the podcast and everything else, but also myself, and my email and contact information is there too. If people have questions or whatnot.
Okay, fantastic. DJ, it's been an absolute pleasure. Thank you for joining us here today.
Well, thank you for having me. I appreciate it.
All right, take care.
Congratulations! Now you've got more of the best tricks of the trade in building massive amounts of passive income from real estate. For more amazing resources, visit realestateinvestingforcashflow.com, and we'll see you next Monday morning.